I hope you enjoyed your Mexican lunch, courtesy of Citius Capital. They're providing lunch again tomorrow for us. I was very privileged last year to be asked to be a trustee of the SIOR Foundation. I think I'm on the committee for grants and students, scholarships. Not sure. Patricia can confirm. But anyway, I'm very happy to be part of that now. It's very important for SIOR. I'm handing over now to Patricia Lovell, who is an SIOR. She's from Kidder Matthews in the west coast of California. And she is the president of the SIOR Foundation, which is kindly sponsor of our keynote speaker. Thank you.
Actually, California would have you believe that Seattle's part of it, but I am in the state of Washington. For those of you who know me, you say, like, Patricia, you're not going to correct them? Anyway, thank you very much. For over 54 years, the SIOR Foundation has advanced professional practice in the commercial real estate community by funding educational sponsorships, critical research projects, real estate curricula for higher education education institutions, professional development syllabi, industry textbooks, and exceptional educational programs and speakers. The SIOR Foundation strives to benefit the entire real estate community by supporting research to identify trends and provide insights that increase industry knowledge. We also promote the best practices, responsible and sustainable development, and the education of the next generation of commercial real estate professionals. Among SIOR Foundation's key beneficiaries are university students enrolled in real estate and business programs, IAMC, and SIOR. In the last 5 years, we have provided scholarships to over 315 undergraduate and graduate-level students from around the United States and Canada. And I hope soon to be extending that into Europe. That wasn't on my script, but that's what we want to do. When these scholarship recipients graduate, they bring new energy and fresh excitement to the commercial real estate community, benefiting other industry professionals with their knowledge, attitude, and drive. In 2013, the Foundation supported SIOR's partnership with IAMC, with funding the IAMC and SIOR Design Flex 2030 project to evaluate the state of industrial property relative to flexibility and reuse, and delve more deeply into the flexibility and adaptable issues within a range of industries and property types. We are pleased that we could help make possible the project's 2 white papers. The first, Designing Flexibility into the Industrial Workplace and Recipe for Change, the Flexible Food Processing Plant. And with 2 more papers to come that will focus on pharmaceuticals and distribution industries. The SIOR Foundation is also pleased to sponsor IAMC's 2016 College of Fellows Leadership Masterclass at the IAMC Semi-Annual Professional Forums. The SIOR Foundation supports SIOR's many innovative and educational programs and speakers from local chapters and SIOR World Conferences, and for the regional SIOR event and this 2016 SIOR International European Conference. Our speaker today is Martin Wolf. He's an associate editor and chief economics commentator at the Financial Times in London. Mr. Wolf has been a Forum Fellow at the annual meeting of the World Economic Forum in Davos, Switzerland since 1999, and a member of the International Media Council since 2006. He was a member of the UK government's Independent Commission on Banking between June 2010 and September 2011. Martin won many prestigious awards for his journalism. Most recently, the Overseas Press Club of America's Prize for Best Commentary on International News in Any Medium for 2013. The James Cameron Memorial Award for 2012, a Distinguished Honorary Fellowship by the European International Business Academy in 2012. Bear with me, because this is a very impressive resume. and in 2012, the International SIOR Journalism Prize, Italy's most prestigious media award. For his service to the financial journalism, Martin was awarded the Commander of the British Empire in 2000. Martin is an honorary fellow of the Nuffield College, Oxford University, and at the Oxford Institute for Economic Policy. For 10 years, Martin was a senior economist in the World Bank and currently holds prestigious positions at a number of important institutions. Mr. Wolf is the author of several books, including The Shifts and the Shocks, What We've Learned and What We Still Have to Learn from the Financial Crisis, Fixing Global Finance and Why Mobilization Works. We are proud to have him here today. Please join me in giving a warm welcome to Mr. Martin Wolf.
Thank you very much.
Thank you, sir.
Okay. I was told very firmly which clicker to use. I hope it's the right one. We will find out. Yes, good. So first of all, it's a great pleasure to be here. I hope this will be a pleasurable break in what otherwise is rather an anxious day for us who are citizens of the United Kingdom. So I imagine we're probably going to talk about that later, but I'm not going to say that much about it during my presentation, not least because I have no idea what actually is going to happen. I have my hopes, which you can guess, and if you read me, you would know, but I can't promise. When anybody introduces me, and that was a very kind introduction, and points out that I was appointed Commander of the British Empire in 2000, I like to say, particularly if it's a predominantly American audience, I imagine this one is, I don't know if this is the case, that the fact that I was awarded this honor shows that whatever else the British have lost, they haven't lost their sense of humor. We will obviously continue to appoint people commanders of the British Empire, not only long after there was a British Empire, but long after people have forgotten that there ever was a British Empire. So it goes on in this completely mythical manner. So what I'm going to talk about where we are. I'm using the headline of the title of my book, The Shifts and the Shocks, as the frame. It's about how the changes in the world economy created the conditions for this enormous financial crisis, with whose consequences we quite clearly still live. And if you're in your business, that must be, I think, pretty obvious. I hope at the end of this talk, I will have achieved one thing, if nothing else. I will have persuaded you all to go out and buy the book and read it, because then you will know what I really think. I've been told I should talk for about 40 minutes, and then we'll have some time for questions and answers. I'm also told this is relatively informal, so you're going to have old-fashioned way microphones. Rather than a Twitter feed or something like that, I rather like the interaction with real human beings. It makes a change. So what I'm going to do in this talk is I'm going to cover 4 topics. First of all, the world economy as it is today. What's going on? This is a very strange configuration that we're in. I'm going to talk really briefly. I'm collapsing it down to 2 charts of how we got here, because it sort of frames the way one thinks about the durability of this situation. I'm going to have a brief discussion of where we might go, particularly sort of near-term outlook for the world economy, which has some quite interesting features. And then I'm going to touch on, depending really on time, a number of really big uncertainties and really important uncertainties, which are a series of questions. And I'm going to try and answer those questions briefly, and then we will have the opportunity to discuss what I have to say. So let's start with where we are. I think there are 2 major features which together are, if you like, the economic puzzle. Somebody's called it secular stagnation. The first is we're in a situation of prolonged economic weakness. The world economy's growth is slowing. This is quite general, and it clearly has is profoundly deep-seated. And the really interesting point about this is that this is the case despite the fact that we have now for roughly 8 years had the most expansionary monetary policies in the history of the world. There has simply never been anything like this. And this contrast tells one something very profound. Obviously, we don't understand all aspects of it, but I think it is possible to sort of work out the main parts of how we got here. And so let me touch upon this briefly. So first of all, this is a chart I quite enjoy because it tells a story of what I like to think of as consistent disappointment. So these are the forecasts from the International Monetary Fund. The International Monetary Fund is taken not because it's a good forecaster, it's as good as everybody else, which is basically lousy, but it has turned out over the last 5 years to be an absolutely consistent forecaster. It's consistently too optimistic. So each successive quinquennium forward is marked down from the previous one. So it's each forecast over a series of 5 years. I've updated it for the last one, for the 5 years ahead. And these are forecasts in what you would probably think of as funny money. We call it purchasing power parity. So every country's GDP is revalued to a common set of international prices. The purpose of this is to compare living standards more accurately. It's not the same as market prices, but the best way of thinking about it is very simply knock off a percentage point or so and you'll get to market prices, roughly speaking. That's true for the world. For the advanced economies, it's pretty close. PPP and market price are pretty close. For the emerging countries, you can probably knock off closer to 1.5%, maybe 1%, something like that. So the basic story is the world has declined, the advanced economies have declined. In other words, the recovery from the crisis was nothing like as strong as people hoped. And the emerging economies particularly have shown a very marked trend decline. And I think the best guess forward, the best guess given the actual outcomes, is that growth in the world economy as a whole is running at about 3% at PPP, which is slightly over 2% in market economy terms. The economy is still growing, is growing every year. Most economies are growing again, not all, but they're growing quite slowly and very much slower than before the crisis. And my own guess, and it's one of those heroic guesses, is that we're never again going to see growth quite as fast as we saw before 2008. And there are very deep reasons for that, the most important of which is demographic. The labor force growth is slowing pretty well everywhere in the world. It's not just in the developed countries, it's also in the developing countries. Now, because I'm assuming that most of you are most interested in the developed countries, I'm going to focus for this presentation on the developed countries. So this looks at the potential growth guessed by past, recent, and forward-looking, again from the IMF, for the advanced economies as a whole. So that's basically Europe, North America, and Japan. Australia is included, but its weight is obviously very small. Now, there are a couple of things here which are really important. First of all, before the crisis hit, real potential growth in the developed countries was running at about 2.25%, close to 3% in the US, much closer, a little under 2% in Europe. That was the basic difference, and below that in Japan. And that was driven by three roughly equal things: capital growth, potential employment growth, which is the number of the labor force growth, and what's called total factor productivity, which is the residual or the best measure of underlying technical progress. What happened between 2008 2014 is three things. One, we began to see this huge demographic transition, which is getting more severe in the later period, 2005-20, because the baby boomers are all retiring. And we're not going to stop that. There is no immigration into the developed world which is going to offset that. So that's just a fact. Demography is slowing, labor force growth is slowing. In Europe, it's now, in the continent as a whole, pretty close to zero. The second thing that has fallen, which is a result of the crisis, is capital growth. There's been a very long period of weak investment. There's a little bit of a recovery in this, but it's not very strong. People overinvested, and they haven't made this up. But the final part, which is the most important, which I'm going to come to a bit more in a second, is the collapse of total factor productivity growth. The measure, the indication that we've got a marked weakening in the pace of innovation as applied to the economy. You might think that we're in the middle of a period of very rapid technical progress with new technologies in the information communications area, but it's not showing itself up in productivity. Looking forward, the IMF forecasts that this will rise, but it depends enormously on a recovery in total factor productivity, of which at the moment we are seeing no sign whatsoever. None. So it's the forecast that the potential growth in the developed countries is running at 1.5% is decidedly optimistic. A more reasonable estimate, I think, is that it's about 1.25%, about 1.75% of potential growth in the US, and probably something close to 1 in the European economy as a whole. That's sort of what potential growth looks like at the moment. I'm not saying it's going to remain like that, but if it is going to change, something has to change from what we've been seeing in recent years. Now, I want to put this productivity story because, in the famous words of one of your Nobel Prize winning economists, productivity isn't everything, but it's almost everything. In the long run, it's new technologies, innovation that has driven growth in our economies over the last couple of centuries, particularly the last 1.5 centuries. This is from Robert Gordon's recent book on the long-run growth of the United States economy, which is, whether you agree with its conclusions, which I do, or you disagree with them, a masterpiece, one of the great books in economics. And what he shows us, which is very important, and I could go into this in much more detail, but it's a way of thinking about where we are, that between 1920 and 1970, US growth averaged, potential growth averaged about 3% a year, and an enormous part of that was due to innovation. And that was because of the application of an immense range of new technologies across basically every aspect of the US economy. Over the last 45 years or so, this engine has been weakening. And that shows itself very clearly in the contrast between the great big blue block for 1920 to 1970 and 1970 to 2014. We saw a remarkable upsurge in productivity in the 10 years up to 2005, which was the internet boom, but that seems now to have expired, at least as far as measurement goes. So we are in a period, and it's now been a very long period, of weakening underlying rate of innovation in our economies. And in my view, the evidence for that is overwhelming and incontrovertible and should be regarded as the background to where we are. Now, this is another way of looking at the same thing. Again, I'm focusing on the US, and the reason I'm focusing on the US is that since it's been the most productive and innovative economy in the world since the late 19th century, it's sort of the forerunner for everybody else. It shows you what can be treated. This is the 10-year moving average of US growth of GDP per hour worked. It goes back to 1960, so 1960 basically covers the 50s. We saw this immense surge of productivity growth, output per hour in the US in the 50s, which could start going up to the, throughout the 60s. Then from 1972-3 onwards, a progressive decline, productivity growth more than halved. It was an immense collapse. That ran along about 1% a year during the 80s and early 90s. It then had what I've called already the internet boom. Other figures show the same thing, reaching a peak of 2.5% in the decade to 2005, and it is now, over the last decade, collapsed to 1%, which is the slowest decadal growth since the Second World War. So this supports what I've already been saying in terms of the growth of supply potential. And again, most of this seems to be due not to the slowdown in investment, though that's real, but rather to the slowdown in innovation or total factor productivity, the residual given by whatever the innovative processes are. My own view, and I'm going to discuss this longer if you want to, is that this is essentially because the innovations we are seeing, though very important, are relatively narrow in their effects upon the economy as a whole. Now, that's the supply side. That's the supply potential. As I said, I think in the developed world, we're talking about 1.25%, maybe 1.5% on a good day, as it were. Now the demand side, and I want to bring this up. I've taken this chart back to 1990 because it brings out something very important. So this is the central bank intervention rates. These are the four most important central banks in the world: the Fed, the ECB, the BOJ, and the Bank of England. And the charts show their most important intervention rates. And you can see that at the moment, the highest rates are those of the Bank of England and the Fed, which are actually very close to 0.5%. The ECB and the Bank of Japan are both negative. Today, a quarter of the world economy is run by a central bank with a negative rate, something that has never happened before. This situation, which you see here at the end, which is close to 8 years of close to zero rates, has no precedence in monetary history. The ECB tried very hard to get away from it. You can see the little green blip upwards. Early in 2011, it precipitated a monstrous crisis, and it had to reverse. Indeed, the crisis in 2012, precipitated in part by this policy, was so monstrous that many of us wondered whether the Eurozone would survive. And that's led to the radical changes in policy that we've seen in the ECB since then. Now, there are two features about this which I think are worth underlining because it indicates what an extraordinary thing this is. The first thing, which I haven't been able to put here, is about British monetary history. Now, the Bank of England is a very old institution. It's been in business since the 1690s. And the Bank of England keeps records of everything, so we know the Bank of England's interest rates that it has afforded on advances to the market and to other banking institutions since the 1690s. The lowest interest rate that the Bank of England has ever applied prior to this last 8 years, ever, and this is in the Great Depression and 2 world wars and the Napoleonic War, was 2%. So we are now a quarter of its historical low. Do we have a huge boom in Britain generating high inflation? I'll come to that in a moment, but the answer, of course, is no. The second thing that is worth noting is that Japan has been where we are now for 20 years. And Japan's main worry is, how the hell does it get inflation up to 2%? I think you can safely say we are in a monetary place which would not have been, and was not, what most people expected. I would have to say that after the financial crisis, I argued in very early 2009, we were going to be stuck in a Japanese-style situation for the indefinite future. I had large arguments with some of my friends who were then in the administration, and I would like to point out, because one always enjoys pointing these things out when one was right, that I was right. So, and our situation looks very, very like that of Japan. Not quite as bad, but very similar. And furthermore, not only do we have the most aggressive monetary policy as measured by interest rates, we also have exceptional aggressive monetary policy as measured by the size of the assets of the central banks. So these are the central bank's assets, or essentially the monetary base over GDP. You can see that in every case, they've increased massively from where they were before the crisis. In the case of the Fed and the Bank of England, to about a quarter of a GDP, from about 5 or 6% of GDP. The ECB briefly allowed them to fall from 30% to 20%. And very recently, in fact last year, the ECB decided that was a monstrous mistake and is now engaged in an enormous QE program which will bring it back up to 30% of GDP. And the Bank of Japan is going into the stratosphere. The only bank above that is the Swiss. I'm not going to go into the the Swiss problem. By now, the Bank of Japan's holdings of government debt and its monetary base are roughly 70% of GDP and rising. So you would obviously assume that this being with these sorts of policies, we would have seen massive growth in demand, verging on hyperinflation. In fact, we haven't seen any such thing. So here I look at demand and output in the US and the Eurozone, just to see what these policies have done. The US has had a progressive growth of real demand and GDP at about 2% a year ever since the worst of the crisis. The crises were very similar. And that's not terrible. Unemployment has shrunk. But this is simply the weakest recovery of the US that we have on record. This is the weakest recovery of the US on record. The Eurozone hasn't had anything that I would really regard as a recovery at all. Real GDP in the Eurozone is now, in the most recent quarter, back to where it was before the crisis, and real demand is still 2.5%. Real demand is shown by the green bars. The green bar is still 2.5% below the pre-crisis peak. So they have been working very, very hard to generate a big surge in demand, bringing up output, and they have recovered from the very bottom, but it's an unbelievably weak recovery. So what about inflation? So I've looked at core consumer price inflation, and the fascinating thing about this chart, there's this big blip upwards in Japan because their core figure doesn't exclude taxes, and they had the consumer tax increase. So you can ignore that blip and just look at the end. The fascinating thing is if you look at these four countries, four economies, only one of them has got core inflation up to its target level of 2%. The other are all wobbling around 1%. In the case of the ECB, despite its recent massively supportive monetary policies, it has failed to hit its target from below, i.e. its core inflation has been well below its target since 2009. So this is why Mario Draghi is getting increasingly anxious. And furthermore, in the forecast period they've just announced, which is 2018, they still don't expect to hit their target. And that, taken together, is why the most important single conclusion is that it is overwhelmingly probable, not certain, nothing is, that this very low interest rate environment will survive for years. And the other way of thinking about the same thing is what's going on in the bond markets, the sort of benchmark bond markets, and I particularly love what's going on in the 30-year bond market. So, because this is a market dominated by actual market buyers, the central banks have bought some of it, but far from all of it. And this was, I think, about a week ago. About that time, the 30-year benchmark JGB was yielding about 0.3%. People were buying 30-year bonds for 0.3%, go figure. And in Germany, it was about 0.8%. Both of these central banks have announced that they are going to try and hit inflation of 2%, and they're going to try very hard. If you believe that their promises are in any way credible, anyone who buys these bonds has bought them at negative real rates of between 1% and 2% for 30 years. That's good for real estate, I suppose. And you look at the more normal economies, or less freakish ones, the US and Britain, I put the US and UK, they are, in the UK case, of course, God knows what will happen tomorrow, was just over 2%, in the US 2.5%. So the UK real yield here, if you believe that the Bank of England will hit its target, is 0, and in the United States it's a whopping 0.5%. The crucial point being that both nominal interest expectations and real interest rate expectations are staggeringly embedded at a low level because of the weakness of demand. Now, one of the reasons for this is that we cannot contain the debt buildup. The overhang of debt in our economies is continuing to rise. And that is, as is well known in economics, large debt overhangs tend to be depressing on demand, and that's what's happened. If you look at the green line, that shows the change in debt as a share of GDP in the whole economy for these 7 major economies since 2007. And you can see, except for the US and Germany, in every case, the overall debt levels has risen dramatically. Secondly, there are only 3 economies where we see any significant degree of private sector deleveraging: the UK, Germany, and the US. In all the others, there's been no private sector deleveraging, and of course, in every case, there has been massive public sector deleveraging as the government deficits have increasingly taken over for private spending in supporting demand over this period. So the debt overhang problem has clearly got worse. And one of the reasons we have such low interest rates, as I said, it depresses demand. And the other reason we have such a low interest rate, because debt depresses demand, is, of course, if we had normal interest rates, everybody would go bust because there's so much debt. And that's one of the things we're trying to do, is stop everybody from going bust. Now, an important feature of the post-crisis, so this is the overall environment, but an important feature of the post-crisis environment, focusing on the larger developed countries, and I've also put Spain and Italy here, is a massive divergence among economies in how well they've coped with this crisis. And that raises some very interesting questions for investors, which is something like this. If a country has done very, very badly, it ought to have the potential for recovery that is far greater than a country that's done very well. So the countries at the bottom look like the countries with the potential. They have exceptional potential because they have exceptionally high unemployment, and they've had a very long period of investment without much growth, because they've had some investment. If that's what you focus on, Spain and Italy look the best candidates for recovery. Of course, they're risky candidates for recovery because they did so badly for a reason. Namely, they have had real problems with their economies. Of the two, I would tend to back Spain. But that's the potential. The second thing to notice is the countries that have done really well on a GDP per head basis have been Germany and the US. Germany best of all. The US has followed it. They don't have huge upside potential. They look as though they're pretty close to full employment, and their growth is going to be in line with potential, and I've already discussed what that is. In Germany, potential growth is certainly not above 1% a year. Important relative to your discussion of real estate. The UK has had a strong recovery recently. Canada did very well too, until recently because of the commodity collapse. The most intriguing cases, to my mind, intriguing case of all is France. France is stuck in absolute stagnation and has been now since 2011. It had a relatively small crisis collapse, and a crucial question is whether France can get itself back in gear anymore. It's the country that's sort of stuck close to 100, moving across. The divergence within Europe is staggering. Over a period of 8 years, GDP per head in Germany has risen relative to that of Italy by more than 20% in just 8 years. It's a staggering divergence. And this, as I said, raises a very profound question about whether Italy and Spain in particular can make the sort of recoveries that will be very rewarding. Let me move now to a completely different part of the world, but the part of the world which I think matters to us enormously, has to some degree shaped the whole world, which is China. What is China's problem? So I'm going to talk very briefly about why China has a problem and why that's going to shape, in a very important way, my story about interest rates for the next several years. In essence, the point here is that China has a hugely unbalanced economy. The process of rebalancing the economy is likely to make China's savings glut, already very, very substantial, far, far worse. That is going to affect capital flows from China and is probably going to increase the pressure on real interest rates in the world as a whole. So let me just cover very briefly. What this shows is the composition of demand in the Chinese economy since 2000. If we go back to 2000, China had a sort of relatively normal structure of demand for an economy which was very fast growing, an emerging economy. About half its GDP was private consumption, another 17% was government consumption, about a third was investment, and 2% was its trade surplus. Over the following 8 or 9 years, two things happened. Investment rose to 40% of GDP, and the current account surplus rose to 8% of GDP, which means, by the way, arithmetically, that savings in the Chinese economy rose from 36% of GDP to nearly 50%. Think about it. Savings in the Chinese economy were half of GDP. Just to put this in context, savings in the US economy are currently, I think, about 14%, something in that neighborhood. So 50% of GDP. Then they hit this monstrous crisis, which we all know about, in 2007-8, and their export surplus disappeared. They realized their export surplus was disappearing, so they decided, well, we've got to replace our export surplus with another source of demand. How are we going to do that? Well, they decided what to do to start the biggest credit-fueled investment boom, particularly property boom, as far as I can see, that has ever occurred anywhere, ever. And the share of investment in GDP rose from 40% of GDP in 2006, 41% in 2007, to 47% in 2011. And consumption went down to private consumption to about 36% of GDP, which I think is the lowest I've ever seen in any significant economy. But at the same time as this happened, underlying potential growth in the Chinese economy slowed dramatically. It was recognized in 2012. It's fallen from over 10% to 6%. So China is now not only investing more than it's ever done before, it's investing more than any economy has ever done before, and its growth rate is slowing sharply. It doesn't take any great genius to work out that the marginal return on investment in China is collapsing. And they know this in the authorities, so what they're trying to do is slow investment growth and raise consumption shares to rebalance the economy while keep it growing. But they cannot allow investment actually to shrink, because if investment were to shrink, given its immense share in demand, it's almost half of demand, the economy would go into recession. So an investment growth must at all costs be halted. An investment collapse must be prevented. But how do they prevent an investment collapse? The answer is very clear. They do it by increasing credit in the economy at a staggering rate. So this is what's happened to credit in the Chinese economy from 2000, 2007, 2015 Q2. And you can see that between 2007 and 2015 Q2, credit in the economy is almost doubled. And it's particularly explosive in the non-financial corporate sector, which of course includes real estate companies. So China's desire to sustain investment to stop a recession has gone with one of the biggest credit booms in history, which is still ongoing. That's, in essence, the Chinese vulnerability and the Chinese challenge. So that's where we are. That's, roughly speaking, I think, where we are in thinking about our world economy today, with these weak supply growth, incredibly weak demand, huge debt overhangs, extraordinary low inflations, a really weird combination. So how did we get here? Well, I'm going to just focus on two parts of the story of how we got here, both of which came from my book. I've updated them for this purpose, and I think they bring out the picture very, very clearly. Because where we are isn't new. It's something that has been building up over really 30 years, at least. So what I've done here is I've got 4 lines. The one to focus on, maybe not as clear as I would like, is the light one, which is the index-linked gilt yield, which is the real interest rate as given by UK government bonds. We've been selling index-linked gilts, what US would be called TIPS, since the 80s. So we've got a very long series of these real interest rates. And the rates are read off on the right side. So this is the light curve. And it's a fascinating pattern because it's so clear that this real interest rate has gone in 3 different periods. There have been 3 different periods. The first period, up to 97, real interest rates were 4%, the world economy was growing strongly. It's basically the configuration you'd expect. The second period, from 1999 till the crisis, real interest rates were quite low, 2%. Remarkably low, given this was a period of very, very rapid real growth. And finally, the period since the crisis, we've got real interest rates wobbling between 0 and -1. We are absolutely stuck now in a period of, going on 8 years, of negative real interest rates. So what demarcates these periods? Well, my argument is between 97 and 99, something very big happened to the world economy, which we in the West tended to ignore, and that was the Asian financial crisis. And the Asian financial crisis had a very dramatic effect on the distribution of savings and investments across the whole world. In particular, the economies with the largest investment, the best investment opportunities in the whole world, the Asian emerging countries, half of the world's population, stopped importing capital, without exception. They all stopped importing capital, net. They continued to import foreign direct investment, but they became lenders, massive lenders to the world economic system. That was particularly true of China, where I've already shown you that emergence. In balancing that, a few economies became very important in balancing that new surge of net lending from the Asian economies. There were some other things going on. And in particular, as the real interest rate collapsed, you start seeing the beginning of the emergence of very strong, very consistent real house price booms in 3 important economies, the US, UK, and Spain, which were the 3 economies, the big economies, with large house price explosions. These were rational responses to lower real interest rates. These were rational rises in the prices of long-term real assets. But of course, as is always the case of this kind, they triggered explosions in lending, in financial risk-taking, in confidence that you could speculate on future house prices, which went to excess. And ultimately, when house prices overshot, when they started to fall, and you can see them beginning to fall from 2006 onwards in the case of the US, a little bit later in the US and UK and Spain, then caused financial crises and the collapse we've seen with these massive debt overhangs, very difficult to get rid of all that debt, as I've already indicated, and this world in which we're struggling with 0 to negative real interest rates, which is a combination of the savings glut condition which existed before with the debt overhang condition which has existed since the crisis, and if anything has got worse. That's my analysis of where we've been. And this situation has not been yet fully resolved. In fact, it takes Ray Dalio makes this point, decades to get out of this sort of situation if you don't want to go through what happened to the US in the Great Depression, which is a complete debt collapse combined with a huge implosion of the economy. So instead, we're trying to grow our way out of this with very low nominal rates, and that's just an unbelievably slow and painful process. Now, a key part of this, there are many other bits of this driver, was the emergence of the global imbalances, which are just another way of talking about these net capital flows, which I've been talking about. So if you start with 98 and move to 2006, you will see a massive emergence of surpluses of capital in current account surpluses, which are net flows of capital, and deficits. And the key point is we are getting the 2 main deficit regions here are the US and peripheral Europe. They're the places where the crises where the crises hit. These imbalances have shrunk since the crisis, but unfortunately one very important imbalance has re-emerged, which is in the emerging world, what I call the rest of the world, and that is why I think the emerging economies are now in such difficulty. These imbalances have not disappeared, they've just shrunk somewhat, but they were a crucial element, in my view, in the build-up to the crisis. Now, the third thing I wanted to talk about then is where we might go. Well, there is some optimism now that the recovery in the developed world is well entrenched and is spreading. I think there's some sign of it. As I've already mentioned, the biggest potential upside is always in the most battered economies, and I've discussed the two most battered large economies in Europe, which are Spain and Italy. The credit cycle is turning in peripheral Europe, that is to say, credit growth is beginning to return, so that might well be the best bet from here on. And I'm going to talk very briefly, because I've been asked to, about what's happening with very important investors, namely sovereign wealth funds. So this is the growth forecast for 2016 from consensus forecasts. Now, the interesting thing about this set of forecasts is that there is only one significant, well, there are two economies where expectations now, in May 2016, that was the latest, are better than they were in January 2015. And they're completely consistent with my point, namely, they're Spain and Italy. Those are the two economies where people are getting more optimistic because they were so depressed before. And Spain is now expected to be the fastest growing of the large economies in the developed world, which I think is rather striking. Italy's growth is still very low. Japan is worse. Expectations for the US, UK, and Japan have deteriorated very significantly over this period, though they're still expected to grow by close to 2% or so. The Eurozone is absolutely constant at just over 1.5%. And again, expectations are going down for Germany. The interesting point is the general tendency is for growth expectations to deteriorate for the economies people have believed to be doing rather well, and to improve for the economies that were battered and are now improving. For Asia and the rest of the emerging world, Asia is absolutely level, India is improving, and Asia is almost universally expected, with very good reason, to be the fastest growing region of the world this year. All the commodity-based regions, particularly Russia and Latin America, Brazil, were absolutely hammered this year. If we look at the 2017 forecasts, again, this is the first forecast was from January this year, and the second forecast was from May. We see, again, US and UK, we're getting more nervous, but with still relative optimism compared to the Eurozone. Germany, again, they're marking it down. France, roughly level pegging. Spain, constant, but Spain's growth is expected to be really quite strong. It could well be, well, close to being the strongest this year. For the Asian countries, India, constant at close to 8%, China at just above 6%, Asia is still the fastest growing region of the world, as it's been basically every year in the last 20 or 25 years. That's an absolutely consistent pattern. Very modest recoveries in Russia, Eastern Europe, Brazil, Latin America. But again, I suppose the interesting bets will be that those pulverized economies will start next year or the year after to show the relatively strong recoveries that would be normal. Finally, on the sovereign wealth funds, I was quite interested in this. Obviously, there's been massive growth in the resources of sovereign wealth funds since 2007. There is now a decline, but the decline between 2014 and 2015 is smaller than I had expected. I suppose it is reasonable to expect, however, that many of the oil-based funds will start shrinking quite considerably if the oil price doesn't start rising above current levels fairly soon, and that could deprive a pretty important source of funds of the money with which to make the investments on the scale they've recently been doing. Let me close by thinking about a few questions that are important in the medium to long term. The first, and in a way most important of all for the future growth of the world economy is what I call the will convergence continue story. I've already made the point that whatever has happened in the rest of the emerging world, Asian growth has been overwhelmingly the dominant story of the world economy since at least the early 90s, in many ways even further back. Asia has grown roughly twice as fast as the world economy for a very long time. That's been overwhelmingly driven by China, but also by India. Indonesia is also recently fast growing. The convergence story is about the performance of those economies. And on that will depend in large part the growth of the world economy as a whole. And personally, I remain reasonably optimistic that it will continue, though as I've already indicated, China has some very big adjustments to make in the next decade or so. The second big question is supply, and particularly potential output in the developed world. The demography is not going to change, and the investment rate is not going to recover dramatically, in my view. There are very strong reasons why companies are not likely to invest massively in physical plant in slow-growing economies. So a lot depends on whether innovation will improve and total factor productivity will explode upwards. The evidence we have is this isn't happening. It isn't happening. And my own view is that technologies we're seeing at the moment are unlikely to change that in any significant way over the next 4 or 5 years. So it is reasonable to assume, though not certain, that potential output will continue to grow at roughly the level I've suggested. A third and much more difficult question is whether we're going to see a spontaneous and powerful growth of demand. Well, there are only two potential sources of demand. The first is a huge investment boom, and that is linked to my second one, the supply recovery. Do we expect major companies to start investing in a very, very large way in physical plant? A second big source of demand is housing, residential accommodation. In the US, that's a relatively plausible source of demand. The population is still young and growing. In Europe, the population is not young and growing, and the migration is not big enough to change this. The numbers are nothing like as big as the headlines would suggest. So a huge housing boom anywhere in Europe seems to me relatively implausible. You could have a bit of it in Germany, but it's not going to be a big source of demand. So I don't see the engine for private sector demand. A massive export growth from the developed world to the developing world is inconceivable because the developing world doesn't have the finance to do it, and China's going to continue to run a surplus. So I don't think the demand recovery will be there, and for that reason, I expect interest rates, and this is 4, to remain relatively low, nominal and real to remain relatively low. We're stuck in this trap for a very long time. Now that gets me to the fifth thing and the sixth thing, which is, are we right to assume that the world in which we live is going to survive? The sort of thing we're used to. Open, globalized, sort of centrist, largely market-oriented with a fair amount of interference, or is something different going to happen? And the biggest question there, obviously, is the populist upsurge we're seeing in the US with Trump, and we're seeing in Britain with the Brexit vote, and God knows what will happen in the Brexit vote. I think this is, to me, becoming the developed world, the biggest single question. These forces can be seen in virtually every developed country. We can see them in Germany with the Alternative für Deutschland. We see them in the Netherlands. We see them in Spain, where they can't form a government. We see them in France, where Marine Le Pen might well win the first round in the presidential elections. I tend to think that the center, what I think of as the center, will hold just about. We will ride through this. The anger about the financial crisis will fade. People will adjust to the changes in their economy, but it's going to be very difficult. There's going to be immense pressure about migration and some hostility to trade as well. And given the things that are going on in the wider world, The pressures for migration will continue, particularly for Europe, massive pressures from the Middle East and North Africa, and these aren't going to be easy to contain. And there are also, quite apart from that, really important frictions potentially with outside powers, notably Russia. And this then gets to my last question, is the basic global order, globalization, economic integration, the thing that has underpinned our growth for most of the last half century. Will that survive? Well, that's very linked with number 5. Yes, we've got low growth, but we've got the policy instruments as long as inflation is under control to deal with it. But will populism get to the point that we start electing people who actually just want to stop trade? They are representing people who want to stop trade. This is very close to the populism question. And again, my feeling is that they will probably survive, but I don't feel anything like as confident as I did a few years ago. So to bring it together, what I'm basically saying is the future is probably going to be more of the same in monetary policies, more of the same effects on real asset prices, pushing up real asset prices and lowering real yields. That follows from a world of very low real interest rates with tremendous political pressures, which we are going to work very hard to contain, but we will probably manage to do so. And that finishes everything I have to say. Thank you. And I'm told I can answer questions, so I think you're allowed to have the first question.
Yeah, I have a question.
There's apparently a microphone.
So earlier this morning, we did an informal Brexit poll with the audience, and the results are 16% voted to leave and 84% voted to remain. Now, this isn't a really great cross-section of voters because we're real estate professionals, well integrated, into Europe. But would you contrast an audience like this against your typical voter, and then can you make any connections to the U.S. presidential elections and compare sort of the Leave voters to maybe the Trump voters?
Well, as I have already indicated, there are clear similarities. There are clear similarities. So there are two things going on which are quite interesting and surprising to me. Well, interesting. So there is a significant proportion of the population of the developed world, and here I'm going to focus on Europe and America, which both feels and to some extent is a loser in the last 35 or 40 years. These are predominantly people who worked who had good jobs in manufacturing or mining, more manufacturing than mining, though mining is relevant in the UK and US, coal mining. Their wages were relatively high and supported really quite a reasonable living standard. Over the last 35, 40 years, the employment in industry has collapsed as a share of employment, but even absolutely. So if you take the UK case, which is extreme, the number of people employed in manufacturing is roughly halved since the early 80s and is now roughly 10% of the labor force, not more than that. Relative wages for this group of people have generally tended to fall relative to people who are skilled and people working in the most successful parts of the service sector, in finance. In some cases, clearly, social conditions have changed, family breakdown, health status, and so forth. So they are genuinely losers. The people who feel like this most strongly are those, of course, who've enjoyed the relatively good jobs before, so they tend to be older, people in their late 40s, 50s, and 60s. So that's the loser point. They are relative losers. Secondly, in all our countries, there has been a very significant rise in the foreign-born population as a share of the total population. They're not dissimilar across Europe and North America. Australia and Canada are a bit outliers here, New Zealand even more so. A large proportion of these immigrants, even if they came in legally, as in Britain, or illegally, undocumented, as you put it in the US, are unskilled. By no means all, of course, but they're the ones people have complained about. And they've taken over a lot of unskilled and semi-skilled jobs. They're very visible, they're very foreign, and people resent that too. I've described migration as globalization made flesh. It becomes real, it's visible, in a way that trade is not. Now, the thing that is interesting about this, it's not completely obvious ex ante why this group of people would necessarily go towards the right rather than the left. You could imagine either. But in practice, the left parties have tended to be pro-immigration and on the balance pro-globalization. Very dramatically so in Europe, the Labour Party, for example. And so they've ended up, partly because their focus is nationalist, nativist, I think it would be called in the US, going towards the right party. Now, the interesting thing about that is that the right party, certainly the Republicans and the Conservative Party here, are parties that are also committed at the same time to globalization, free trade, free markets. So that creates a real intellectual problem for these parties, a really deep problem. Are they basically nativist, slightly racist, I don't want to overdo that term, and trying to pull up the drawbridge, or are they free market, free trade sort of parties? That conflict was absolutely dead center in the Brexit campaign, because they've tried to run both things at the same time. We hate immigrants, but we love globalization and the free market. It's a very strange thing to run at the same time. But that's where it's driving the free market, what I call the center free market party, or the center right party. And how the center-right party, the Republicans or the Conservatives, resolve what I think is an absolutely insoluble intellectual conflict is one of the biggest questions in our politics, exactly similar in America and in Britain. In France, it's not the same problem because they've got their own party. The Front National is their own right party. It's not part of the right configuration, though Sarkozy always tries to attract some of these people, if he becomes the candidate, it seems unlikely, into the centre-right, because he thinks if the centre-right is going to win, it has to attract a lot of the Front National parties, people. And it's a bit like, because we've got UKIP, which has a similar sort of pull, it's a bit like trying to pull in the UKIP voters into the Conservatives. In America, of course, everything is within the umbrella party. Now, then the question comes to be, is this sort of populist movement going to win power, a populist nativist movement going to win power? I think it probably isn't. In a one-off referendum like this, where other issues don't arise, there are going to be other people who are going to vote for Brexit, people who think very strong, who believe the EU is stopping completely free markets and free trade, people who are very keen on the idea of national sovereignty, along with the sort of people I've described. They don't have to agree a coherent program. They just have to agree on Brexit. The Brexit campaign has no coherent program. They just have to agree on Brexit. So in a referendum, they can win. In a national election, I think they can't. In fact, all the parties are riven on these issues, and the Conservative Party most of all. I think the same applies to the Republicans. I don't really believe that but you will tell me how wrong I am, but I don't believe that the coalition, the narrowed coalition that Mr. Trump can put together is a winning coalition. And I'm pretty sure that if the Conservative Party stood for election on anything like the program that of the enraged populace, it will be defeated. So I think there's it's an incredibly important part of the Brexit campaign because it's a pure negative campaign. It's a campaign against something, but it's not necessarily a winning coalition or a workable coalition for national power. But final point, I know this is a very long answer, because it's what I was saying in 5, my final point is we're going to be living with this for decades. This is not going to go away. This is just part of the political background, in my view, certainly for many, many years, because we don't have any simple way of resolving these problems. Gentleman over here.
Can you talk about low interest rates and asset bubbles?
Well, it's an implication of what I'm saying is that they're not really asset bubbles. Obviously, there's a really deep question of what is an asset bubble. I tend to think of an asset bubble as a set of asset prices that cannot be explained in any way by underlying economic forces. This doesn't imply that the asset prices are sustainable forever. They're not. They will change. But my feeling is, I'll give you an example. Given the real interest rates we have, and one of the reasons I put that chart, which took the real interest rates back to 1995, is to show that they are the product of very long trends which have existed for quite a long time. There's lots of evidence that real interest rates, measured however you like, I've just put one measure, have been falling for 30 years, 25 years. So the real interest rate on long contracts, with not just after QE is stopped, is about 0 on safe assets. The real interest rate on safe assets is about 0. And that's true for 10 years and it's true for 30. Now, I don't think there's any theory that can say that's purely a product of monetary policy. At least there's no normal theory that can say that monetary policy can deliver 30-year real interest rates at this level. I think it reflects fundamental factors in our economy, which is the chronic weakness of demand relative to supply, and the chronic weakness of demand, I think, is due to the fact that there's very weak incentives to do fundamental investment, and there's a hell of a lot of savings in the system, both globally, China and all the rest of it, and also within our economies, because we have high profit shares, we have had increases in inequality which have shifted income to people who save more. So we've got a savings glut condition which has got worse. The crisis has made it worse. So the real interest rates are what they are. Now assume that the real interest rates are 0. They really are. Just assume it, give it for the moment. Then are asset prices too high? No. Not obviously. If you look at stock prices, these are better measured. Getting real return aggregate figures for real estate are more difficult. Anyway, you know much more about that. But if you take the S&P and you look at its real return on a cyclically adjusted basis, what you seem to be getting is an equity risk premium in the neighborhood of 3 to 4%. 3 to 4 percentage points. 3 to 4 percentage points equity risk premium is well within the range of historical margin. So given real interest rates of 0, the S&P does not look overvalued. Whether real estate is overvalued given real interest rates on safe assets of 0, I am not competent to judge. You can work that out yourself. So I don't think it's a bubble. However, that doesn't mean it will last. Because then the question comes, it's very easy to argue, but must be true. Real interest rates will not remain 0 forever. Something is going to change. Something's going to change. The question is when and how. What I have been arguing here is you can imagine it's changing, but I at the moment can't see how it can change soon at the global level. Indeed, the thing that is most obviously happening in the world at the moment, which is the slow deflation of the massive Chinese investment boom, its slowdown, which is clear, desired, is going to make this condition worse. It must make it worse. You've got an economy, you know what, this is one of my favorites for you. Chinese gross savings every year, gross savings, are $5 trillion. Do you know what US gross savings every year are? Less than 3. China's gross savings are pretty well those of equal to US and Europe together. Not quite. And they don't have the investment opportunities at home, which are profitable, to invest and absorb that monstrous flow of savings. Well, they can reduce it a bit. There are things that will happen that will reduce it a little. But I think a lot of it's going to go into the world, and that's going to make the excess savings condition worse. So my view is real interest rates are low for a reason, 0 for a reason. That's why they're structural. It's very easy to imagine they will continue to be low for quite a few more years, not forever. And that being so, real asset prices are not in a bubble. They're just very high. And the thing you have to work out is how long you think that will last and how big the agony will be when it will change, because it will. And when it will change, there are going to be some very, very big losses. And the most important question is whether the regulation of the banks on the capital side is sufficient to make them survive those losses without another financial crisis. That is a really big question. When the normalization finally happens, my guess is in the 2020s, but who knows?
Yesterday we had a debate around manufacturing in Europe, and everybody was talking about moving over to Asia Pacific. You've kind of indicated here it looks like it's going to be a little flat. Could you expand upon that a little bit?
The moving of manufacturing to Asian Pacific?
No, the actual growth in Europe around manufacturing.
Well, basically, there isn't any. I mean, the reason for that is fairly obvious. I don't think there's much in the US. It's been growing about 1.5% a year. I haven't looked at the exact figures. You can correct me. But the basic point seems to me very, very, very clear. Our economies, I argue, are growing potentially maybe 1% a year. There's a recovery potential in Europe. So we could have 3 or 4 years of 1.5 to 2. That rests really on whether whether Spain and Italy, which are the important ones, are going to really recover, and France. Germany is close to potential, very clear. All German economists would agree. It's close to potential. So Eurozone could grow a bit faster. Maybe it could grow 2% for 4 years. Maybe a little more, but not much more. And then it goes down to growth of 1% or so. The US potential growth looks like 2, maybe. So if manufacturing grew in line with the growth of demand in these economies, which is going to be roughly in line with GDP, there are big little wobbles because of current account balances shift, but basically then you've got 1% growth in Eurozone in the long run, 2% maybe for a short period, 2% in the US. Then the question comes, well, what proportion of that growth in demand for manufacturing will be satisfied by domestic output, and what proportion by imported output? There's one other addition. Sorry, I should say that. To a first approximation, manufacturing growth is driven by domestic demand. Then I'm introducing net trade. Okay. Economies like Germany have been able to have manufacturing grow significantly faster than the economy because their trade surpluses have risen, because they're so competitive. The trade surplus in Germany is now roughly 8%, 9% of GDP, which is astonishing. Can it go up to 12 or 13? Well, it clearly can't do so on the demand in the Eurozone. That's not likely. So that means a huge boom in the emerging world. They've done incredibly well in China. That's coming off. The rest of the emerging world is in trouble. I would be amazed if German exports grew faster than the German economy over the next 5 years. Over the last 5 years, they've grown roughly in line. So roughly 1.5% each. I think the idea that of a net export surplus of the developed world growing substantially in the years ahead depends on the emerging world running ever larger deficits doesn't look very plausible. It's just about possible. It's not going to be a big deal either way. So imports, we're not going to regain, we're not going to substitute, well, that's actually one caveat. On the import substitution side, China might be replaced by Vietnam. Will we start making lots of things we've been importing? The argument for that we will start making lots of things that we've been importing is that the robotics revolution will make that possible. I have no feelings about that. But if it's true, it means that we would have a stronger manufacturing sector and no jobs growth. So you could imagine our manufacturing sector improving, growing more strongly than our economies, but basically because we've pulled it back because we can now do without workers. That is a two-edged sword. But even so, it's very difficult for manufacturing in the developed world to grow much faster than our economies. We're just too big a part of the total. And if our economies are growing as slowly as we are, I suggest, I think manufacturing doesn't grow much more. The other thing that would drive a lot of manufacturing is if we had a real investment boom, because that's very manufacturing intensive, also construction intensive. But as I've already indicated, I can't see why companies which are living with basically low growth economies are suddenly going to go out and make huge investments. I mean, think about the major industries where you have really expensive plant. Refinery, oil product demand is hardly growing. We'll pick up. Car plants, I mean, we've got more car plants than we could possibly imagine using. We're not going to do, so we just put in IT. IT drives output of the IT industry, nearly all of which has gone from the developed world. So it seems to me, if you add all this together, it's very, very difficult to see how manufacturing grows faster than our economies, which is somewhere between 1% and 2%. And over time, its share seems to be steadily declining at market prices because its relative prices are falling. A friend of mine argued 20 years ago that manufacturing was going to become the new agriculture. Incredibly efficient, incredibly productive, employing almost nobody, and a very, very small share of our GDP. And that, by the way, looks to me exactly what's happening. Anybody else? Yes, please.
Zion wrote a book, The Accidental Superpower. He said that he forecasted a world going from being flush with capital to being short of capital with rapidly increasing interest rates caused by the baby boomers retiring in very large numbers and stopping their production of capital and consuming capital, pulling capital out, and not being replaced by a demographic of Gen X and Gen Y, which has much smaller numbers. Do you think there's any possibility that that will happen?
Yeah, that would be part of your 2020s type model. At the world level, there are two factors that will be important. One will be the aging of our societies, which you've described, and that could be important in the 2020s. There is a countervailing factor. I don't want to push it too far because China is sort of slightly on the opposite side, but it's not. China's a long way from being quite in this position, but which is that in high growth countries, savings rates tend to rise quite rapidly because the incomes and therefore savings of the younger generation are much larger than those of the old generation. So in countries like India, I expect savings to rise quite a bit if they continue to grow at 8% a year. China is sort of on the cusp. It should fall now. So I think from a household point of view, savings should be at the world level, which is crucial for this, might well start to decline in the in the 2020s. But there are two opposing factors to that. The first one is the share of capital. So what we're talking about here is household savings. One of the interesting things that has happened is there's been a very large rise in the corporate profits share of GDP across the developed world, and these haven't been distributed, or at least only to a limited degree, obviously through buybacks and so forth. There are a whole host of reasons for that. So one of the questions is, will the profit shares decline? I can't see why, but they might. And the second is, will all the ultimate owners whom you described, all the old people, force them to distribute and start dissaving from that, which hasn't happened. That was going to be quite a big shift in corporate management, but it could happen through buybacks and other means. So that's the one thing. The second thing, however, is the investment side, because the story you're telling is, yes, the savings rate will decline. What's going to happen to the investment side, the demand to create capital? Well, in this aging world you've described, yeah, the savings rate might go down, but I would expect the investment rate to go down even more. In a very elderly dominated economy, what are we going to be investing in? Housing, but there are fewer young people than there were. In China, the investment rate, I predict, is going to go from 45 to 35. What's that? That's my guess. But it's a big shift. India already has quite a high investment rate. It's already well into the 30s. Is it likely to rise much? I don't see a huge investment boom in Africa. So the really interesting question to me is, what is the investment boom going to be in? Well, one possibility, my friends would argue, is the complete re-engineering of our energy systems to make them low carbon. That's an interesting possibility. But the crucial point, and I haven't read this book, so I might not have got the subtlety of the argument, is that I think the argument on savings is quite plausible, though I don't know how far I would go. People have been making this argument for a long time. It hasn't worked. But I think the really interesting question is, what are they going to be investing in that will drive the demand side? What are we going to be doing? Well, one of the biggest parts of this is real estate. Now, I'm going to throw out something that you probably won't like, but my view is that a lot of the IT we're now seeing is capital saving, and quite a bit of what it's saving is capital in real estate. So that's a really big chunk of investment. Without a real estate boom, construction boom, it's very difficult to have an investment boom in any of our economies. And I don't know where that was going to be. So I'm agnostic on this. But it was certainly not what we're seeing now. Certainly not what we are seeing now. So I don't know what it's going to be like in the 2020s, but I think you should assume that the sort of world we're in now will continue for a little while longer, which that's what I think.
Thank you, Richard. Does anyone have one quick last question for a quick reply?
I think this will be fairly quick. I'm not an economist, so I hope I don't mangle this. But my understanding, some people have been expressing an idea that perhaps the reason that growth and productivity seems so low is that are we measuring the wrong things? Do the things we measure for the economy, they don't take account of the more intangible aspects of the digital economy, and they're not set up for that? Do you think that's significant, or is it really by the by?
Okay, my normal answer to that question is half an hour. So what? Because it's so big. It is so big. But so I will collapse it down to 1 minute. As you probably noticed, I'm not good at answering questions quickly because they're so complicated and everything. So briefly, I think that the measurement of productivity is the measurement of productivity in the productive system, the output system that we measure, which excludes household production and household consumption, and always has, very important, okay? It's just about the productive system, which is the things, the things we buy and sell, basically. In that context, I don't think the measurement problem has got to any significant degree more difficult in the last 6 or 7 years. So my favorite answer you will have seen in my output per hour chart. That gets it very beautifully. It was booming to 2005 and has collapsed since then. I promise you, nothing has happened to the world economy since 2005 that means that the statistical services of the developed world cannot measure things that they could measure 10 years ago. Essentially, the economy is more or less the same. This leaves us with a second point, which is a subtle point, and I'll just leave it to think about, which is, that's true. Let's grant that's true. All the work that has been done by all the serious analysts, and I can refer you to chapter and verse from the Council of Economic Advisors in the US, would support what I've said. The measurement of our economic system is not unreliable, or at least it's no more unreliable than it used to be. In many ways, it's probably better. So I don't think that's the problem. The question would rather be, are there things going on outside the productive system that give us immensely much more pleasure than we used to get from things going on outside the productive system? So we're understating the value of Facebook and all these other fun things to us in so significant a way that we should really change our view of the welfare we're getting from all this. And my answer to that is very, very simple. Facebook, electric light, and the washing machine. You make your choice.
Thank you very much. Thank you, Martin.